Let's go to international markets now. And Europe is having quite a stressful day, with even the Spanish shopping siesta to be scrapped to try and kick along the economy. Well, I'm joined now from Singapore by Grant Williams, strategy advisor for Vulpes Investment Management and author of Things That Go. Grant, welcome to the programme.
Hi there, Tiki.
Well, stock markets tumbling today across Europe. We had on Friday the 110 billion euro Spanish bank bailout being signed off, but I now see that Valencia and possibly other regions in Spain are asking for government assistance.
Yeah, Valencia is the first one to actually come out and say they need to refinance 2.5 billion euros this year, which ordinarily wouldn't be a problem for them. But let's face it, Spain is, if it's not in a depression, it's on its way to a depression. They've got 25% unemployment and things are really, really bad there. So they've come out and asked for a bailout. The government doesn't really have the money for them. There are other regions in Spain. Catalonia's in worse shape than Valencia. But at the end of the day, we knew all this. This shouldn't be a surprise to anybody who's been paying attention. We knew when the elections came out that this was going to be a problem. It's the same playbook that Greece had. The numbers get brought out in the true light of day when a new government comes in. They've hinted at this before, and suddenly it's become a problem for everybody. And with Spanish 10-year yields at 7.5% now, it's way gone past the point where it's sustainable. And we've even got elected Spanish officials now criticising the ECB for not buying more Spanish bonds in the secondary market, which is ridiculous. I mean, The problem is the numbers need to be fixed. You can't just keep buying bonds to make it all go away. It doesn't work that way.
Yeah, you say that 10-year bond yield is now at 7.53, I think, the high, the euro era high that it hit. But also, I think just as worrying, 2-year debt yields in Spain are now at 6.74%. Because that's what Spain's been trying to do, borrow short. But those yields are now getting to almost unsustainable levels. How is Spain going to finance itself now?
They can't. It's simple. They can't. I mean, something needs to be done now. This was always going to happen, Tiki. We've been talking about this for a year now, and everyone's been kind of hoping it goes away. They've stuck Band-Aid after Band-Aid on this problem. But eventually, the mechanics of debt will catch up with you, and they will force you into the hard decisions. And that's happening to Spain right now in front of our eyes. Now, I don't see what they can do to fix this, to be honest with you. I've been saying that for a long, long time. But we really are nearing the end game. And as you approach that end game, the speed tends to pick up very, very rapidly. And with the length of time it takes them to make any decision in Europe, they're just not going to be able to get ahead of this now.
Markets down in Spain. The market's also down considerably in Italy. And now I see reports in La Stampa that 10 Italian regions are having trouble with finances.
Yeah, there's too much debt. Pure and simple, this whole problem is there's too much debt. It's rife across Spain, it's rife across Italy, and now, miraculously, Greece, which has gone away from the front pages a few times, is now back in the headlines because on August the 20th, Greece has to repay 3.8 billion euros to the ECB. And they're not going to be able to do that. And suddenly we've got the German economy minister saying that Greece could well be asked to leave the euro, and they think that the point where the scare tactics are over and Greece could leave and it wouldn't be such a frightening prospect now. This whole thing is going to unravel. No matter what anybody says, they can't fix this now.
Yeah, well, the Greek Prime Minister was talking to Bill Clinton, I think, and calling this time Greece's depression, just like the depression in the United States. We've got the Troika debt inspectors turning up in Greece in the next couple of days, I think. They're going to be calling for more austerity. Greece is going to be saying we can't do any more, we want to recut a deal. This presumably is going to be yet another standoff.
Well, we saw there was a very interesting development late on Friday night. A very senior economist at the IMF resigned, a guy called Peter Doyle, and he wrote a resignation letter, which was absolutely scathing of the IMF, and it used words like, I'm ashamed to be associated with. This guy's been there for 20 years. He was a very high-profile guy. It's been a disaster, etc., etc. Hey presto, on the Monday morning, when the Troika, as you say, due to visit Athens, we now start to see the language hardening up, and the IMF starting to say that we may have to let Greece go if they can't pay this money back. So things are moving. Ultimately, they're moving in the right direction. This all needs to take place, and the time for hoping they can fix it by kicking this can down the road, those days are over, I'm afraid.
Briefly, Grant, how do you think the markets are going to go today?
Look, they're going to struggle. Pure and simple, they're going to struggle. We still have this uncertainty. We saw weakness here in Asia. A lot of that was reflecting what's been happening, what they missed on Friday night with the weakness in the States. But realistically, all eyes are going to be on European policymakers, and I suspect the headlines coming out of all these countries across Europe now are not going to be good. With the euro's down at 121, it's flirting with that level. If it breaks 121, it could fall considerably further. So we're in the end game now, Tiki, and as I say, things are going to pick up pace now.
Quite a shift in Europe. Grant Williams, thank you very much for joining us.
Always a pleasure.